Welcome back to the Daily Crypto Roundup. Today, we're breaking down a sharp shift in the crypto market, with Bitcoin dropping back below $70,000 and the entire market turning red. But more importantly, we're going to explain why this is happening. We'll be covering the macro pressure coming from the Federal Reserve and rising oil prices, the sudden reversal in ETF flows as institutional money steps back, the technical rejection that triggered this move, and what analysts are now saying about the risk of further downside. We'll also touch on regulatory developments that, under normal conditions, would have been bullish, but are being completely ignored in today's market. By the end of this episode, you'll have a clear understanding of whether this is just a short-term pullback or the start of something more serious. Let's start with the market structure itself, because that tells you a lot about what just happened. Bitcoin had been pushing toward the $75,000 level, building what looked like momentum for a continuation higher. However, that move failed. The market could not sustain itself above those levels, and the rejection that followed has now taken price back under $70,000. In trading terms, this matters far more than the drop itself. A rejection signals that buyers were not strong enough to maintain control, and once that weakness is exposed, it tends to trigger a chain reaction of selling, particularly in a leveraged market like crypto. Ethereum has followed the same pattern, falling back toward the $2,000 range after briefly showing relative strength earlier in the week. XRP, Solana, Cardano, and Dogecoin have all moved lower in tandem, reinforcing the idea that this is not an isolated move but a broad risk-off shift. The total crypto market cap has declined accordingly, and Bitcoin dominance remains elevated, showing once again that altcoins are not leading this market. They are reacting to it. This is still a Bitcoin-driven environment, and when Bitcoin weakens, everything else follows. Now, to understand why this is happening, we need to step outside of crypto and look at the macro environment. The Federal Reserve has held interest rates steady, but more importantly, the messaging from the central bank has reinforced the idea that rates are going to remain higher for longer. This is not a neutral signal. It is a tightening signal. When the Fed indicates that it is in no rush to cut rates, it effectively removes the liquidity tailwind that risk assets rely on. At the same time, inflation data from the U.S. Bureau of Labor Statistics shows that while headline inflation has cooled, it remains above the Fed's target, and core inflation is still persistent. This creates a situation where policymakers are forced to remain cautious, and that caution translates directly into tighter financial conditions. Analysts at Goldman Sachs have recently reiterated that the market may be underestimating how long restrictive policy could remain in place, noting that financial conditions will likely stay tighter for longer than equity markets are currently pricing. That view is now being reflected in crypto. But the real catalyst today has been energy markets. Oil prices have surged sharply, driven by escalating geopolitical tensions in the Middle East. This is not just a background story. It is central to what is happening. Higher oil prices feed directly into inflation expectations, and rising inflation expectations reduce the likelihood of rate cuts. That chain reaction is what is driving the current move. As JPMorgan analysts, including Nikolaos Panagirtsoglou, have pointed out in recent notes, macro-driven volatility is once again dominating crypto markets, particularly through inflation-sensitive channels such as energy. What you are seeing today is that exact dynamic playing out in real time. This brings us to institutional flows, which are confirming the weakness rather than contradicting it. Over the past 24 hours, Bitcoin and Ethereum exchange-traded funds have recorded significant net outflows, estimated at over $200 million. That is a meaningful shift, especially considering the inflow momentum we had been seeing previously. ETF flows are one of the clearest indicators of institutional sentiment, and when those flows turn negative, it tells you that larger players are reducing exposure rather than adding to positions. James Butterfill, head of research at CoinShares, has consistently highlighted the importance of these flows, stating that institutional positioning tends to lead rather than follow price in the current cycle. In other words, when money starts leaving these products, it is often an early signal of broader risk reduction. That is exactly what we are seeing now. This is not panic selling. It is controlled de-risking, and that makes it more significant. At the same time, derivatives data is showing increasing stress within the system. Funding rates have remained negative across several major exchanges, indicating that a large portion of the market is positioned short. Under normal circumstances, this could create the conditions for a short squeeze. But the problem is that macro pressure is overriding that dynamic. According to data analyzed by Glassnode, the market has recently moved out of a dense accumulation zone between roughly $59,000 and $72,000, entering a thinner liquidity region where price movements can become more volatile. Their latest commentary notes that once price exits high-volume nodes, the potential for accelerated moves increases due to reduced historical supply. That works in both directions, and today we are seeing it play out to the downside. Further supporting this view, analysts at Sentiment have pointed to elevated leverage and fragile sentiment, noting that crowded positioning combined with weakening price action creates conditions where downside moves can cascade quickly. This is where liquidation risk becomes a real factor. If Bitcoin continues to trade below key levels, leveraged long positions begin to unwind, and that unwinding can accelerate the move lower in a self-reinforcing cycle. Now, one of the most important takeaways from today's market is what did not happen. Despite the release of new regulatory guidance from the U.S. Securities and Exchange Commission and the Commodity Futures Trading Commission, the market did not respond positively. Under normal circumstances, clearer regulatory frameworks would be considered bullish, as they reduce uncertainty and make the space more accessible to institutional capital. However, today that news has been completely overshadowed by macro conditions. This is a critical signal. When positive developments fail to move price higher, it indicates that sentiment is weak. As market strategist Noel Acheson, author of the Crypto is Macro Now newsletter, has often emphasized, in risk-off environments, good news is ignored and bad news is amplified. That is exactly the phase we appear to be entering. At the same time, there are early signs of strain within the industry itself. Reports of layoffs and cost-cutting measures across parts of the crypto sector suggest that companies are preparing for more challenging conditions ahead. While these developments are not yet widespread, they align with the broader shift in sentiment. As analysts at Messari have noted, operational tightening within crypto firms often precedes or coincides with periods of reduced market activity and lower capital inflows. This is not a definitive signal on its own, but in combination with everything else, it adds to the overall picture. Perhaps the most important narrative shift today is the continued failure of crypto to behave as a defensive asset. In a period of rising geopolitical tension and increasing uncertainty, assets that are perceived as safe havens would typically attract capital. Gold, for example, has historically benefited in such environments. Bitcoin, however, has moved in the opposite direction. This reinforces the idea that, at least in the current cycle, crypto is still being treated primarily as a risk asset rather than a hedge. This is a point that has been made repeatedly by analysts such as Lynn Alden, who has argued that Bitcoin's correlation with risk assets tends to increase during periods of tightening liquidity. Today's market action supports that view. Rather than acting as a refuge, crypto is being sold alongside equities and other risk-sensitive assets. So where does that leave us? In the short term, the market is clearly under pressure. The rejection at 75,000, combined with macro tightening and institutional outflows, has shifted momentum to the downside. In the medium term, everything will depend on how these macro conditions evolve. If inflation continues to show signs of persistence and central banks remain cautious, it will be difficult for crypto to sustain a strong upward move. However, if conditions begin to ease, the underlying structural developments, including regulatory clarity and institutional integration, could provide a foundation for recovery. In the long term, the fundamentals of the space remain intact. Infrastructure is still being built, adoption is still progressing, and major financial institutions continue to invest in the ecosystem. But as always, timing matters. Markets do not move in straight lines, and even in strong long-term trends, there are periods of significant volatility and correction. Right now, the key level to watch is that $70,000 area. If Bitcoin can stabilize and hold above it, the market may find a base and begin to consolidate. If it breaks lower, the risk of a deeper move increases significantly, particularly given the leverage currently in the system. ETF flows will also be critical. Continued outflows would signal ongoing institutional caution, while a return to inflows could indicate renewed confidence. Ultimately, what we are seeing today is a reminder of how interconnected crypto has become with the broader financial system. This is no longer a market that moves in isolation. It is influenced by macroeconomic conditions, geopolitical events, and institutional behavior in ways that were far less pronounced in earlier cycles. And that is both a challenge and an opportunity. Because while it introduces new sources of volatility, it also brings greater legitimacy and integration into the global financial system. For now, though, the message from the market is clear. Risk is being reduced, liquidity is tightening, and crypto is reacting. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.